Hey guys, welcome to an all-new video. Today I'm going to talk to you about the 10-11-12 system. Now this system was derived by Marc Lichtenfeld, and you can find a lot of information concerning this system, or this method if you will, in his book called Get Rich with Dividends. I'm going to reference the book down below. You guys can have a link to that goes right through Amazon. And you can purchase the book if you like to. I highly suggest you do. It's a very easy read, full of useful information and very wide sorts of examples that you can base yourself on when you read the book. Now, the 10-11-12 system concerns dividend stocks. So it's a way that can help you choose stocks that will, at the 10-year mark, give you a 12% annualized gain and an annual 11% yield from there on. All right. So he bases himself on three important criteria, and I've talked about each and every single one of these criteria, these metrics that we will use in a lot of detail in previous videos. So you guys can check that out. I will also put a little annotation here, a little card to help you guys locate these videos easily. But we've talked about these, so I'm not going to go into much detail about all of these. But basically, he bases himself on the yield, so the dividend yield. He bases himself on dividend growth, and he also bases himself on the payout ratio. Now, the way I look at it is the yield is sort of a picture of the present moment, how strongly the company can pay out dividends right now. The growth is sort of where it's headed in the future, and the payout ratio is how safely you can bet that it's going to get there in the future. All right, so how sustainable is it? So let's just start off with the yield here. He says you should target stocks that have a yield of 4.7% or higher. Now he says you shouldn't only look at the yield. You shouldn't blindly chase a yield, because obviously it can't represent a whole company and the safety underlying that given dividend. But a starting yield is very important, and it's important that it's high enough for you to get somewhere eventually. So you want a strong starting point here. So he says if you have to go down to 4, it's okay, but if you can get that 4.7, that's where it's going to really lock in that annualized 12% growth in the future. So next, the dividend growth rate. So the dividend growth rate annualized for the last decade, he says you should have it at least 10%. All right, and we've talked about that in previous videos, and I also look at least 10%, or I try to get it as close as 10% as I can. So this is an idea of where it's going. This is sort of the momentum of the stock, and how strongly or how important the growth will be for that dividend. So that's also important, especially in the long run, that you have a decent growth associated with that initial yield in order to get those gains further along the line. Now, the last one is the payout ratio. So that's sort of the safety surrounding that dividend payment and how likely it is to get cut in the future. You want that payout ratio to be under 75%. And if you want to be even safer, you calculate that payout ratio based on the free cash flow of the company, which basically means whatever cash they have on hand after they're done paying their expenses, they're done paying their research, they're done paying debts, they're done paying everything they have to pay, whatever they have left in their pockets, that's the money they have available to pay the dividend. So it's a lot safer to assume the dividend is going to be paid after they're done paying every single one of their other expenses. So with that said, you can assume that if nothing else has changed and you've managed to pick a stock with a yield of at least 4.7%, and again, 4.7%, you want at least 4, because the average inflation rate in the US for the last century is 3.4%. So you want to at least beat inflation. So 4, and if you can, 4.7, that would be really optimal. A dividend growth rate annualized for the last 10 years of 10%, and a payout ratio that is under 75% will give you a stock that at the 10-year mark will be giving you 11% annual gains, and will have given you for the last 10 years an average of 12% annualized gains. Because of that compounding that's happening, and because of that growth that you're getting, you're accumulating more stock, you're getting more dividend, and we've talked about compounding and the power of compounding before. So it just puts compounding into effect here, and you get a full-fledged example of what it can do and why it's such a powerful tool. So this, in a nutshell, is the 10, 11, 12 system. He talks about a lot of examples, a lot of nuances concerning free cash flow and everything else that I'm not going to go into detail. If you want more detail, read the book. I highly suggest it. It's a really great book, an easy read as well. So I'll link that down in the description down below. If you guys like this video, don't forget to leave me a thumbs up. Comment down below in the video about what you would like me to talk about in future videos. Don't forget to share it with your friends, and don't forget to subscribe. Have a good one, guys.